All right, let's talk about something you've almost definitely seen advertised, probably late at night, the reverse mortgage. It gets pitched as this absolute dream come true for retirement, but, the reality is a whole lot more complicated. So today, we're going to peel back the layers and see what's really going on. I mean, that pitch is so tempting, isn't it? If you're a homeowner over 62, the idea of getting tax-free cash out of your own house and you don't have to worry about monthly loan payments, it sounds almost too good to be true. And honestly, that promise is exactly what pulls so many people in. But what's hiding behind it? Okay, so let's just start with the textbook definition. A reverse mortgage is, at its heart, a loan against your home equity. But here's the twist. Instead of you paying the bank every month, the bank pays you. And the loan itself, plus all the interest and fees that pile up, only has to be paid back once you permanently leave the house. That's the simple version. To really get the full picture, here's the roadmap for our discussion. We're going to start with that big promise. Then we'll dig into how it really works. After that, we'll unpack the surprisingly high costs, look at some of the hidden risks, and finally, see what this all means for your family and what other options you might have. First things first, let's get into the mechanics of this thing, because before we can really talk about the pros and cons, we've got to understand exactly how these loans are put together and how the money actually gets to you. So it turns out there are a few different flavors of reverse mortgages. The one you're going to hear about 99% of the time is the home equity conversion mortgage, or HCM for short. These are the ones insured by the federal government. You've also got private loans that might let you borrow more, and then some very specific single-purpose loans. But for our purposes today, we're really focusing on HTMs. You also get to choose how you want your money. You can get it all at once in a big lump sum, set up a line of credit you can draw on when you need it, or get steady monthly payments. And believe me, this choice, how you take the money, can have massive consequences down the road. So, the big question, how much cash can you actually get your hands on? Well, that depends on a few things: your age, the current interest rates, and what your home is worth. But just to give you an idea of the scale we're talking about, the current federal limit for one of these insured reverse mortgages is $1,149,825. Okay, now for the part that doesn't make it into the commercials, the price tag. That whole no monthly payments thing doesn't mean the money is free, not even close. In fact, these loans come with a whole laundry list of fees that slowly but surely eat away at the equity in your home. Just look at this list. It's a lot. You've got origination fees that can be up to $6,000, all the usual closing costs, and then this swabber, an initial mortgage insurance premium that's 2% of your home's value. And it doesn't stop there. You've got ongoing interest compounding, monthly servicing fees, and an annual mortgage insurance premium. All of this just gets tacked onto your loan balance, growing and growing over time. And this quote right here really says it all. When financial experts run the numbers and add everything up, they almost always find that these loans end up being more expensive than a regular traditional mortgage. So the takeaway is pretty clear. The convenience you get up front, it comes at a really high price. But the costs aren't just about money. There are some serious hidden dangers that can actually affect your ability to stay in your home. This is where we have to look past the shiny advertisements and really get into the fine print. Let's be crystal clear about this, because this is probably the biggest myth out there. Even though you don't make monthly loan payments, you can absolutely face foreclosure and lose your home with a reverse mortgage if you don't hold up your end of the bargain. So how does that happen? Well, it comes down to three main responsibilities you still have as the homeowner. You have to keep paying your property taxes, you have to keep paying your homeowner's insurance, and you have to keep the house in good shape. If you drop the ball on any of those, the lender has the right to call the loan due and start foreclosure. Hey, remember we talked about how you choose to take your money? This is where it gets really, really important. If you take a big lump sum, all that cash sitting in your bank account is considered an asset. That could suddenly make you ineligible for needs-based programs like Medicaid or SSI. Taking monthly payments is usually safer because it's treated as income. Now, the good news is this doesn't affect your Social Security or Medicare at all. There's also a huge risk for your family, especially for a spouse who isn't on the loan with you. For a long time, if the borrowing spouse passed away or had to move into a nursing home, the loan would come due immediately, and the spouse left in the house could actually face eviction. Now, there are some new rules that offer more protection, but they can be complicated, and it's definitely not a guaranteed safety net for everyone. So that brings us to the next logical question. What happens after you're gone? Well, for your kids or other heirs, a reverse mortgage can create a really complex and stressful mess, turning what should have been an inheritance into a major financial headache. As soon as the lender sends out what's called a due and payable notice, a clock starts ticking. Your heirs typically have just 30 days to figure out what they're going to do. They can sometimes get extensions, but the pressure to make a massive financial decision in such a short amount of time is just immense.
They basically have a few paths they can take. They can try to pay off the entire loan balance and keep the house. They can sell the house, pay back the loan, and keep whatever profit is left. Now, if the loan is underwater, meaning more is owed than the house is worth, there's a special protection where they can sell it for 95% of its value and the insurance covers the rest. Or they can just hand the keys over to the lender and walk away.
Now, here is one last, absolutely crucial piece of protection for you, the borrower. It's called the right of rescission. Federal law gives you 3 business days after you sign the closing papers to cancel the whole deal for any reason at all with no penalty. It's a vital safety net if you get cold feet. And it's so important to remember that a reverse mortgage is not the only game in town. There are other, more traditional ways to tap into your home's value, like a home equity line of credit, a HELOC, a standard home equity loan, or a cash-out refinance. And very often, these options are a lot less expensive and way less complicated. So after all that, it really comes down to one final big question you have to ask yourself. For some people, in some situations, a reverse mortgage might truly be a financial lifeline. But for a lot of others, the crazy high fees, the strict rules, and the potential burden you're leaving for your family, it all begs the question, is getting that cash today worth the very real long-term cost? That's the trade-off. That's the reality.